all paths lead to Bitcoin. I'm not calling for a collapse of the economy per se, or the financial system. There are definitely things that can be band-aid solutions, but no matter what, the 100% certain outcome is fiat debasement, because they need to continue to print more fiat to pay the debt burden. The problem has always been the system, but the system itself has never been as levered as it is now. So what happens as you increase the leverage in the system, frequency and severity of the downturns increase. As long as the market accepts that, the system can continue. But the only 100% certain conclusion is the debasement of fiat, which means you need to set an investment portfolio that protects you against that 100% certainty. Bitcoin, I believe, is the best asymmetric trade opportunity and investment opportunity I've ever seen in managing risk for over 35 years.
Former hedge fund manager and analyst Greg Foss gives us his prediction for the introduction of BlackRock into the crypto space, which he says will drive Bitcoin's value to a range between $1.5 million and $2 million per coin. Greg Foss has been analyzing the financial and Bitcoin modeling landscape for years, and his mathematical knowledge in understanding Bitcoin is put on full display. Foss discusses the BlackRock Bitcoin Spot ETF and its potential repercussions on Bitcoin's pricing dynamics. Greg envisions that the introduction of a spot Bitcoin ETF will attract a substantial influx of approximately $50 billion in capital into the Bitcoin ecosystem. This prediction is significant when we consider that the collective value of Bitcoin available across all exchanges currently hovers around $150 billion at the current market rate. Make sure to stay tuned in until the conclusion of the video, where Greg provides an in-depth breakdown of his belief that, as Bitcoin inches closer to achieving a market cap of around $4 trillion, institutional players will find themselves compelled to enter the Bitcoin market, thereby propelling its price north of $1.5 million per coin, and potentially even higher.
Let's be clear. The fiat system has always been this way. And history will tell you that fiats always fail for this exact reason. Because they print money. In the times of the Romans, they clipped the edges of the coins and took out the gold and the silver from the coins. So fiat systems always fail. And we're just recreating that same problem in a modern age with central planning that is not just central planning of, let's say, the Roman Empire. It's the central planning of every single fiat country in the world, all operate on the same model. So we can blame the system. We shouldn't be surprised because those systems always fail. But then there's a great reset and you start fresh again. But the pain to start fresh is monumental. And people just forget that, you know, these crises have happened over time when fiat fails. And you can look in Venezuela right now, or Argentina, that's defaulted 4 times in my career. But we're not used to it in G7 countries. And here's the problem. It's now caught up with the G7 countries, because when in the 1980s, when inflation was really high, there was a Fed chairman by the name of Paul Volcker who did raise interest rates to close to 20%, 20%. But the difference was the federal debt at that time was far reduced from the current level of over 120% of gross domestic product. At that time, it was around half of that. And it's you can actually raise interest rates when your total debt to GDP is there, because the interest expense on the debt will grow, but it won't bankrupt the whole system. Now we're at a point where total debt to GDP is 120%, which is to say when you raise interest rates even to 5%, the interest expense on the existing debt is growing so quickly, you can't keep up with the expansion, the organic expansion of the debt. And that's where we are right now. So the system is to blame, but we are now at a point where we can't reverse it. You see, after the great financial crisis, there was the chance to be able to reduce this mathematically. I don't think the political wherewithal existed to reduce the debt, but mathematically you could have achieved that. Now it's impossible to achieve that. We are at a point where the debt spiral is so large that no matter what you do, you can't reduce that debt burden enough. The economy can't grow fast enough to keep up with that expanding debt burden. It's mathematically impossible. So that's where we are right now. It's not good, but math doesn't lie. That's the problem. When interest rates are low and going lower, people say, well, the cost of debt is so cheap. That's the problem. They don't stay low forever. Everyone thought they would, but Jerome Powell's a donkey. You know, he said 3 years ago, we're going to be lower for longer. And then, oh, inflation. Yeah, but it's going to be transitory. Now, no, we're going to be higher for longer. Like this is a clown show. And that's the problem you get when you hire administrators and put them in a risk chair.
Foss believes BlackRock is about to shake up the crypto market in the first part of 2024. He reassures that a long-expected surge awaits leading up to the highly anticipated 2024 halving event for Bitcoin. Foss confidently predicts that explosive growth is looming on the horizon.
We're not in a good spot right now, Ryan, but you have to be honest with yourself. That's the mathematics of it. Okay,
I know.
So let's not just talk about, the best way to do is look at the entire world, because it makes the math so easy. In the total world, total global debt, which includes all debt, sovereign debt, bank debt, mortgage, real estate, blah, blah, blah. Total global debt is $400 trillion, okay? And that compares to total global GDP of slightly under 100 trillion. But to make the math easy, let's assume that total global debt is 4 times global GDP, okay? And that debt is a contract. That's what a debt is a contract to pay principal and interest and return the principal to the lender at maturity. But that interest coupon is the cost of doing business, right? And so what would be a good interest rate to put on all the debt in the world? And I'll make it easy for you. I always pick 3%, which is very low because US 10-year rates right now are 3.35%. So assuming all the debt in the world is right around US 10-year, the cost of debt, that's a very generously low assumption, but stick with me. If your numerator, which is total global debt, and your tax base is your denominator, GDP, is it likely that your denominator is going to grow at 4 times 3%, which is 12% annually, to keep pace with the organic growth of the debt, just because of the coupon, right? No. Is global GDP going to grow at 12% forever? No,
absolutely
not even close. There is the definition of your debt spiral. You cannot keep pace with your tax base with the organic expansion of the debt because it's 4 times the size of the economy, and it costs you, as I pointed out, generously 3% annual. That is the debt spiral. And the error term to solve that spiral, print, baby, print. If I was 30 or younger again, yeah, you're up against it a bit, but maybe you don't actually have to buy that house that everybody always told you to aspire to, because what happens if you buy that house and the world goes to heck in a handbasket? You don't want to be bolted down to a fixed object like a house. If you can't get out of the country because you can't sell your house or whatever, I'm not saying everyone wants to leave Canada, but that is one of the considerations when you own a hard asset. You have to understand portability, liquidity, transferability, all the things. And if I was under 30, I would actually focus on accumulating a given percent of my net worth in Bitcoin. Because Bitcoin, I believe, is the best asymmetric trade opportunity and investment opportunity I've ever seen in managing risk for over 35 years. Totally different things, okay? So I actually believe Bitcoin to be incredibly unrisky. In fact, I believe Bitcoin is insurance And since it's insurance against the fiat Ponzi, I advocate everybody needs to own some Bitcoin, or else they're actually taking higher risk by owning zero. Let's walk through that again.
Yeah.
You need to own more than 0% of your portfolio in Bitcoin, or else your portfolio is actually higher risk than if you had a proper portfolio allocation. Now, the proper portfolio allocation is going to depend on the age, the family obligations of the individual, the lifestyle choices. Like, if you absolutely have to live in a house, then I'm not going to tell you not to live in a house, meaning, or own your own house. If you have to, just because that's your personality, that's fine. Just understand some of the risks that come along with owning a hard asset. It's a house. So all of this is to say, everything changes with your age, your income, your family responsibilities, your personal risk tolerance, and your lifestyle desires. But don't own zero. Look, if you own zero Bitcoin at any age, you are doing it wrong. Okay? You're exposing yourself to more risk than if you actually had X% of your portfolio in Bitcoin. And generally, for the non-believers, go and get 5% of your portfolio in Bitcoin. I know it sounds like a lot, but it's not. You still have 95% of your portfolio in other stuff. And this 5% could literally go up 100-fold from here, which means that 5% turns into 500%, everything else being equal. That's beautiful. That's asymmetry. Asymmetric returns define careers, or return opportunities define careers. So I have a price target on Bitcoin of over $2 million per Bitcoin in today's dollars. I got to be real clear about that, in today's dollars, which again, given it's trading at 25,000, is plus or minus 100 times higher. Damn, that's a pretty decent friggin' return opportunity.
Foss challenges the conventional macroeconomic metrics, asserting that these metrics are often manipulated to paint a specific narrative, like labor statistics and inflation figures, which are selectively measured to create desired effects rather than reflecting the true state of the economy. In this context, Bitcoin emerges as an alternative, detached from the manipulations of the conventional economic sphere, and highlights that established corporations like Apple, Amazon, and Google will use their established relationships acquired over decades to swiftly acquire substantial amounts of Bitcoin through a spot ETF, bypassing the cumbersome processes involved in procuring the actual commodity. This disparity underscores the transformative power of cryptocurrencies in traditional financial institutions. Greg Foss underscores the importance of embracing owning digital currencies, as the economic landscape is changing rapidly, and urges investors to leverage Bitcoin's potential to secure a more prosperous financial future. What do you think about the latest interview with Greg Foss? And how do you think Bitcoin's trajectory in the coming months will impact the crypto market and the world of investing? Comment down below. Thanks so much for watching. Don't forget to hit the like button and subscribe for more content just like this. We'll see you in the next video.